Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, October 13th, Columbus Day at 9:20 Mountain Time. Our note this week was titled Capital Account Rebalancing. We began with a discussion that we titled a Nasty Reminder, and that reminder is that uh, increased tariffs are a tax and they slow growth. They don't create inflation. That was readily apparent in the price action on Friday. Economically sensitive stocks fell sharply, credit spreads widened, and bond yields fell. About a third of the decline was attributable to the break-even inflation component of Treasury yields across the curve, and the balance of the move lower in yields was attributable to the real or inflation-protected component of something of a proxy for growth. So ignore all the Fed speak about this being a bigger risk to their inflation mandate than their growth mandate. Don't understand how, after 6 months of the market sending clear messages, they could continue to espouse that nonsense, but they continue to do so anyway. We did, by the way, end the note with some thoughts, brief thoughts on the 5 finalists for the next Fed chair. So we moved on to have a broader discussion about capital and current account rebalancing. We began the discussion with, why people think gold has been rallying, why it broke 4,000 last week. That was the trigger for this discussion, was the questions we were getting around that. Some have described it as dollar debasement. Others have talked about inflation, and still more have talked about the U.S.'s unsustainable debt. While there's certainly an element of truth to all of those explanations, for us, the bigger, broader story is a rebalancing of global capital and current accounts that would reduce demand for treasuries over time and leave countries still running current account surpluses with a choice about what they hold in their sovereign wealth funds or in their foreign exchange holdings. European debt is a pretty poor alternative to U.S. treasuries. It's a fragmented market. You could buy bunds, you could buy French oats, Italian BTPs, Spanish bonos, but each market has their own liquidity and dynamics, and it's just not a good alternative to U.S. treasuries. And so ultimately, we think that the long-term outlook for gold is somewhat dependent upon whether there is an event, and we are in circumstances similar to the early 70s when Nixon ended the dollar gold standard. The Bretton Woods agreement fell apart. He enacted global tariffs, all in an effort to try and rebalance global trade. And it did shrink the U.S. Deficit for a time. We then had the Plaza Accord after the deficit widened again under Ronald Reagan. Again, that caused the current account deficit to shrink for a time, but we're at all-time wides. And it's pretty clear, even if you looked at the Chinese trade data last night, so far they're trying to divert their excess capacity to Europe, but we don't think the Europes are going to really tolerate that for all too long. And so the real driver of all this is these mercantilist, export-dependent economies and their policies, which have created these massive global imbalances. And of course, that implicit acceptance by U.S. Politicians, at least until President Trump, that is. We went on to discuss how we think Treasury Secretary Bessent has played a role in all this, and currency is integral to the trade negotiations. For full details around all this, become a paid subscriber and you can really dig into this. We then moved on to a broader discussion about U.S. growth being weak. There's a number of indicators pointing to this. We looked at gross output, which is the broadest measure of economic activity. Unfortunately, we don't get it on a timely basis. We only have it through the second quarter. But if you look at Fastenal's results this morning, it was pretty consistent with this idea that business-to-business intermediate transactions are weak as well. And the manufacturing sector, much of the U.S. economy really is weak. The Bloomberg daily retail sales transactions data is weak. And business development companies, the BIZD ETF that has a lot of private credit in it, private credit managers in it, is quite weak as well. And we do think that the economy is much weaker than the performance of the S&P would lead you to believe. We then went into financial sector earnings preview and how it's absolutely critical that we get small bank return on equity above 10% to start getting them to grow assets, make commercial and industrial loans, in essence, provide credit to small businesses. All those things are probably 1 quarter or so away. So the numbers that start tomorrow will be good for the big banks, not so good for the smaller regional banks. But still, we would stick with those smaller regional banks because we do think Fed easing is going to have a profound effect on their profitability. And then wrapped up with our thoughts on the Fed chair. And bottom line here is we absolutely think capital markets expertise is critical. So of the 5, you can figure out which 2 we're talking about that have that capital markets expertise. So that's it for me this week. Barry Knapp from Ironsides. Please consider becoming a full paid subscriber to our Substack research. We think you'll really like it. Have a good week.